Let's get right to it. Money moves the world, and two currencies matter most: the US dollar and the euro. These two currencies are at the heart of global finance, shaping economies, trade, and even the way we travel or shop. The dollar is America's currency. The euro is used across much of Europe. Together, they represent the economic engines of two of the world's largest markets. These aren't just bills or numbers. They're symbols of economic power, trust, and influence. They're the backbone of international trade and investment. When their values shift, the effects ripple everywhere, across continents, industries, and into our daily lives. Why should you care? Because their relationship impacts what you pay for gas, electronics, even your next vacation. Exchange rates can make things more affordable or suddenly more expensive. A strong dollar makes European trips cheaper. A strong euro makes European goods pricier for Americans. The balance between these currencies can change your travel plans or your shopping list. The dollar has long been the world's reserve currency, trusted by governments and businesses everywhere. But nothing lasts forever, and the global landscape is shifting. Change is coming, and it affects everyone, not just Wall Street or big corporations, but families, travelers, and small businesses too. Today, we're breaking down a major Goldman Sachs report that's making waves in the financial world. They predict the euro will strengthen while the dollar weakens, a shift that could reshape global markets and your personal finances. This isn't just financial trivia. It's a signal for your wallet, your savings, and your future spending power. We'll explain what's happening, why it matters, and what you can do to stay ahead of the curve. Understanding this is the first step to protecting your financial future and making smarter decisions. When one currency rises, the other falls. It's a global seesaw, and the balance is always shifting. The dollar's dominance is being challenged, and the headlines are just the beginning. Goldman Sachs sees a shift, and you need to pay attention, because these changes could impact your life in unexpected ways. We'll walk through their findings, step by step, so you can understand what's really going on. This is about your money, your future, and the choices you make today. Let's get smart about the dollar, the euro, and what comes next. Ready? Let's dive in. Here's the headline: Goldman Sachs expects the US dollar to weaken in the coming months. This isn't just a blip on the radar. It's a trend that's been building for some time, and now it's starting to catch the attention of major financial players. This isn't panic, it's a gradual shift. For years, the dollar has been the world's heavyweight, the currency everyone turned to in times of uncertainty. But now, the balance is tipping, and the global financial landscape is evolving. The euro is set to benefit, not because Europe is suddenly booming, but because the dollar is losing ground across the board. Investors worldwide are watching this trend closely, weighing their options, and considering how to position themselves for what's next. If the dollar weakens, you'll need more dollars to buy a euro. The exchange rate could climb, making European travel and imports more expensive for Americans. Everyday purchases, from luxury goods to simple vacations, could start to feel the impact. Goldman Sachs is so confident, they've raised their targets for the euro. The story isn't about a crashing dollar, but a slow, steady change in global currency power. This is a shift that could reshape international trade and investment strategies. The dollar's broad decline is the main driver here. The euro is simply riding the wave, gaining strength as the dollar steps back from its long-held position. This is a clear signal. The financial winds are shifting. When the winds shift, you need to adjust your sails. Investors, businesses, and even travelers will need to rethink their strategies. The dollar's era of dominance is being tested. The euro is poised to rise as the dollar steps back, and this could mark the beginning of a new chapter in global finance. Pay attention. This shift could impact your finances in ways you don't expect. From the cost of goods to the value of your investments, the ripple effects could be far-reaching. Let's see what's driving this change. Why does Goldman Sachs see the dollar weakening? It's a mix of factors, each playing a significant role in shaping the currency's future. The US economy isn't pulling ahead like it used to. Other regions are catching up, narrowing the gap that once made the dollar so dominant. Investors are moving money out of the US in search of better growth elsewhere, especially as global markets become more competitive and attractive. To do that, they sell dollars and buy other currencies, like the euro, shifting the balance of demand in the currency markets. Interest rates matter too. If US rates fall or other countries' rates rise, the dollar loses its edge, making alternatives more appealing to global investors. The dollar's long run of strength may simply be ending. Markets tend to revert to the mean, and cycles of strength and weakness are natural. After years of being overvalued, a correction is due, and that process can take time as markets adjust to new realities. All these forces combine to push the dollar down, creating a powerful momentum that's hard to reverse in the short term. Goldman Sachs sees the path of least resistance for the dollar as downward, given the current global economic landscape and shifting investor sentiment. It's not about one big event, but a series of shifts, subtle changes in growth, policy, and confidence that add up over time. The world is rebalancing, and the dollar is adjusting, reflecting a new era in international finance. This is how global finance works: cycles, corrections, and new opportunities always emerging as the landscape evolves. The euro stands to gain as the dollar steps back, opening the door for new winners in the global currency race. If the dollar weakens, the euro naturally strengthens. These two currencies are locked in a global tug-of-war. When investors sell dollars, they often buy euros, the world's next best option. The Eurozone is a massive, stable economy with deep financial markets. As money flows out of dollar assets, it flows into euro assets, pushing the euro higher. The euro doesn't need to outperform. It just needs to be the best alternative. The dollar index and the euro often move in opposite directions. When the dollar falls, the euro rises. It's that simple. Goldman Sachs highlights this strong correlation. The euro is positioned to benefit from the dollar's decline. Sometimes being the runner-up is enough to take the lead. That's the dynamic at play right now. The euro isn't just rising because the dollar is falling. Europe's economy is showing real signs of life. Recent data points to growing momentum in the Eurozone. Forward-looking indicators suggest brighter days ahead. Optimism is returning, and that attracts investment. Europe's recovery is becoming more solid and self-sustaining. A stronger economy means a stronger currency. Investors are taking a fresh look at Europe. The euro's rise is a two-part story: dollar weakness and European strength. Both are working in the euro's favor. Let's zoom in on manufacturing, Europe's economic engine. New manufacturing orders are up, signaling future growth. This means factories are busy, jobs are being created, and confidence is rising. Strong manufacturing boosts exports, increasing demand for the euro. When foreign buyers want European goods, they need euros. Rising orders are a bullish sign for the euro. It's not just good news for factory workers, it's good news for the currency. Manufacturing strength is fueling Europe's comeback. Investors notice these trends. The euro is gaining momentum from the ground up. There's another force at work: big money managers. For years, European investors poured money into US stocks, hedging against dollar risk. But if US markets underperform, they may shift back to Europe. Selling US assets means selling dollars and buying euros. Even reducing hedging can lift the euro by easing selling pressure. Goldman Sachs sees this as a subtle but powerful shift. If asset managers move their money home, demand for the euro jumps. It's like removing a weight that's held the euro down. This change in strategy could give the euro another boost. Watch what the big players do. Their moves matter. The euro's rise isn't just about economics. It's about where the smart money flows. That flow could be turning toward Europe. Beyond economics, Europe is talking about deeper integration. Leaders are considering joint borrowing and new spending to tackle big challenges. Joint bonds would create a safe euro-wide asset, like US Treasuries. Loosening strict debt rules could boost growth. Greater unity makes the Eurozone look stronger and more stable. Investors like stability and shared purpose. If these ideas become reality, the Euro's appeal will soar. It's a long-term story, but a powerful one. A more unified Europe means a more attractive Euro. The future could be very bright for the Eurozone. So, what does all this mean for you? Simple. Think globally. The dollar won't always be king. Currencies move in cycles. Don't put all your eggs in one country's basket. Diversify your investments. Consider international funds or ETFs. When the dollar weakens, foreign investments can shine. This helps balance your portfolio and protect your wealth. Be a global citizen with your money. Stay informed. Read, learn, and watch for big shifts. You don't need to be a currency expert, but you do need to pay attention. Knowledge is your best defense in a changing world. The dollar and euro are dancing. Don't get caught flat-footed. Be smart, be diversified, and be ready for what's next. The world is changing, and so should your financial strategy. Don't just react, plan ahead. The future belongs to those who adapt. You've got this. Stay sharp, stay global, and protect your financial future. That's the smart money move.